Welcome to the Explainer. So, right now, we are looking at a deeply fascinating, kind of crazy market setup. We've got this expected September rate cut from the Fed, an AI boom that absolutely refuses to slow down, and all of this is colliding head on with rising consumer debt in some incredibly stretched stock valuations. Listen, navigating this environment requires total precision. You can't just throw darts at a board anymore and expect to win. So, today, we're breaking down 4 highly discussed stocks: Costco, Etsy, CAVA, and AMD, and giving you a clear, actionable playbook. All right, let's jump right in. The absolute core thesis for everything we're going to unpack today boils down to this: quality is expensive, growth is risky, and value is hiding in plain sight. I want you to keep this single idea tucked in the back of your mind. It is the definitive lens through which we're going to view every piece of data, every metric, and every strategic call we make in this explainer. Here's our playbook for today. We'll start with the current market setup. Then we'll look at Costco, Etsy, CAVA, AMD, and finally, we'll wrap up with a winning portfolio strategy. Okay, Section 1, the current market setup. We are sitting in a market right now that's defined by a massive tension between headline-grabbing optimism and some pretty stretched realities. It's like a giant tug of war. On one hand, markets are eagerly pricing in that September rate cut, and the AI boom is just pumping massive liquidity into the tech sector. But on the other side of the ledger, consumer debt is steadily climbing, and valuations across the board are stretched entirely too thin. Why does this matter? Well, when everything is priced for absolute perfection, even the slightest disappointment can trigger a huge sell-off. Navigating the specific setup requires precise, surgical decision-making. You can't just blindly buy the index right now. Moving to Section 2, Costco, the premium fortress. Look, in a market with rising debt and uncertainty, investors naturally flock to safety. That brings us to our first archetype, Costco. The raw data here perfectly illustrates why it's considered a fortress. They just did a 10-for-1 stock split, and the business metrics are staggering. August net sales hit $19.8 billion, up 7.1% year over year. U.S. comparable sales are up 5.6%, excluding fuel. But here's the craziest number to me: the impact of their recent membership fee hike, which is their first since 2017. That fee hike alone adds roughly $100 million in pure profit straight to their bottom line every single year. It makes sense, right? In a slowing economy, consumers trade down to bulk value, and Costco perfectly captures that shift. But, and this is a big but, here is the harsh reality of buying quality in today's market. Costco is trading at a price-to-earnings ratio of 55 times. That means you are paying $55 for every $1 of company profit. Their historical average is right around 30 times earnings. So the takeaway here is that while the underlying business is rock solid, you are paying a massive premium for that safety. Like we said earlier, quality is undeniably expensive right now. So here's our definitive playbook for Costco. If you already own it, you hold it, it's a fantastic business. But if you're looking to buy, you've got to be patient. Only add on a 5 to 8% pullback. You have to mentally categorize this stock the right way. Do not go in expecting 20% annual returns from these sky-high valuations. Costco is your portfolio's volatility shield. It is not a growth engine. Let's hit Section 3, Etsy, the contrarian bet. Sitting on the exact opposite end of the spectrum from Costco, we have Etsy. This is the contrarian value play. 16 times. That is Etsy's ridiculously low forward earnings multiple right now. Historically, Etsy is traded at multiples of 30 or even higher. But the stock has been absolutely crushed lately because gross merchandise sales have been slowing down. Remember our intro quote? Value is hiding in plain sight? It's just currently covered in a little bit of dust. The battleground for Etsy is super clear. On the risk side, this is undeniably a turnaround play, and they are facing very real, very aggressive competition from giants like Temu and Amazon. But the bull case, that's what makes a 16x multiple so incredibly tempting. Etsy actually has a genuine moat in unique, handcrafted goods. You literally cannot commoditize what they do on Temu. Plus, they've got a new CEO aggressively cutting costs and focusing strictly on high-value buyers. If they can just stabilize their sales, the math suggests this stock could realistically double in the next 3 to 5 years. So our call on Etsy? It's a speculative buy under $60. But listen, here is the golden rule for this kind of setup. You must size it correctly. Keep it small. We're talking 2 to 3% of your total portfolio, tops. This is a high-risk, high-reward bet on management execution. You do not want a turnaround story acting as the anchor for your entire financial future. All right, Section 4, CAVA, the momentum trap. If Etsy is deep value, CAVA is what happens when market momentum completely detaches from business fundamentals. CAVA actually has pretty poor fundamental scores, yet it is trading at nearly 200 times earnings. 200. For context, think about Chipotle. Chipotle is a seasoned, highly profitable leader growing even faster in the fast casual space, and they trade at just 50 times earnings. The juxtaposition is just brutal. CAVA might be a solid restaurant concept, sure, but this price tag is dangerously detached from reality. Our call here literally couldn't be clearer. Avoid CAVA, or if you own it, sell into this momentum strength. In an environment where valuations are this stretched, all it takes is one single earnings miss, and a stock priced for 200 years of perfect growth is going to drop 20 to 30% overnight. If you're a long-term believer in Mediterranean fast casual, wait for a major correction down below $50 before you even think about touching this one. Next up, Section 5, AMD, the AI Challenger. We've covered the fortress, the turnaround, and the trap. Now for our final archetype in the market's hottest sector, AI. The most crucial point about AMD right now is actually how they're funding their future. Their profits are booming, they have $5 billion in cash sitting there, yet they are aggressively borrowing money. Why? To build data center GPUs. Honestly, it's a brilliant piece of capital allocation. They're using cheap debt to fund massive growth expenditures. But we have to acknowledge the market reality here. Nvidia currently owns over 80% of the AI chip market. AMD is the clear, undisputed number 2. Now, being number 2 in a multi-trillion-dollar market is insanely lucrative, but it does cap their absolute upside. They're playing second fiddle, and the valuation needs to reflect that reality. Our call on AMD? Hold it as a core growth position if you've already got it, and aggressively add on any dips below $140. Based on their cash flow and growth trajectory, fair value sits really comfortably between $180 and $200. It's a fantastic holding for the next 3 to 5 years, just as long as you keep your expectations grounded and realize they are not dethroning Nvidia anytime soon. Finally, Section 6, Winning Portfolio Strategy. We've thoroughly analyzed 4 very distinct archetypes today. Let's zoom out and pull all this together into an actual strategy you can implement. Given the macro tension we talked about at the top of the explainer, here's how we're structuring our allocation. We want roughly 60 to 70% in equities, 20% in bonds, and crucially 15 to 20% sitting in cash. Why so much cash right now? Because historically, September and October are volatile months. By holding cash, you are fully armed and ready to buy the dips when over-leveraged investors are forced to panic sell. Now, when it comes to deploying that 60% equity slice, precision is your best friend. You want to overweight high-quality companies and deep value. Add to defensive sectors like healthcare, utilities, and consumer staples, exactly like we talked about with Costco. On the flip side, you absolutely must avoid overvalued small-cap stocks and stay far away from unprofitable tech. Do not get caught in momentum traps like CAVA when the fundamentals just do not support the price. But here's the kicker. Your strategy fundamentally changes based on your age and your goals. If you're under 45, you have the runway to let compounding do its thing. You should treat market dips as prime buying opportunities to pick up assets like AMD or Etsy on sale. But if you're nearing retirement, the playbook completely flips. Your job is wealth preservation. You should be taking profits on your high-flying winners and rotating that capital into the safety of bonds, especially while they're still offering really attractive yields around 5%. The single biggest mistake investors make is treating all stocks exactly the same, totally ignoring their own personal circumstances. Costco is your anchor. Etsy is your calculated bet. CAVA is a momentum trap. AMD is your growth horse. Your job is to match each of these profiles to your unique risk tolerance. So I'll leave you with this. What is your investing time horizon? Are you buying, holding, or selling right now? Drop a comment with your time frame, and let's figure out exactly how this market setup impacts your specific journey. Keep learning, keep analyzing, and we'll see you in the next explainer.